So good afternoon. Thank you everybody for joining us today. We're happy to have expert advisor Jay Wilson back with us for the fourth time this month today to talk about business entity choices and their implications to your business. Throughout his presentation, if you have any questions, feel free to send them our way through the Q&A functionality in Zoom if you're viewing us that way. Or if you're viewing us through Facebook, you can comment on the post and we'll monitor those questions as well. Before we get started, just want to do a brief introduction of PCV for those of you who may not be familiar with us. Pacific Community Ventures is a nonprofit dedicated to the support and success of small businesses. Our mission is to invest in small businesses, create good jobs for working people, and make markets work for social good. We do this through our fair and affordable lending program, our free business advising program, and our impact measurement research and consulting program. If you're not already involved in our business advising program and you'd like to be paired with an expert advisor like Jay, I encourage you to sign up after this call. I'll share out all the resources and links and information later today. So we're so grateful to have Jay back with us. Like I said, it's the last of our Summer Financial Empowerment webinar series with Jay. If you missed his last few webinar sessions, I'll share out the recordings of those after this call. And if there are any topics you'd like to see Jay or any of our other expert advisors cover in the future, feel free to reach out to me afterwards with suggestions. All right, Jay, I'll turn it over to you so we can get started.
All right, let me go ahead and share my screen here. All right. So I'm just going to go over the various types of entities. Some of these won't apply to a brand new business, which I'll explain in a moment. So I'm going to start with the ones that are most common for a new business, and then we'll transition into when to look at other entities when your business gets more complex and off the ground after a few years. So this might only take a little bit. I've been using QuickBooks and I've been showing people around with that, and it's taken the whole hour on the 3 last webinars that I did. But here it might only take a little amount of the hour, probably about 30-40 minutes. So that's what I'm hoping, and so I can answer your questions, because I'm sure you have questions about this stuff. And I'd like to get some feedback about the concerns of people that are just starting out when it comes to choosing the type of legal business entity. But this one is the most common, and it's the easiest to form because you basically just start your business and there you are. There's no filings to be had with the Secretary of State's office in your state. Most businesses have a rocky start, so it's best if you have a fledgling business and you don't know how it's going to work out to start as a sole proprietor. You know, there's companies out there that want you to form an LLC right away because they want to charge you a fee to form the LLC. But it might be a better option for some who, you know, don't know how it's going to work out, which that's more new businesses than others who know that they're going to be making a decent amount of money really quickly. And I don't recommend, you know, going head first into the LLC route, and I'll show that later in the LLC slide, some of the responsibilities of having an LLC. In most states, there's a separate tax return you have to file, and there's fees and stuff annually that you have to pay to have the LLC, because again, you're filing with the state. So Usually you want to avoid as many responsibilities as you can, but we'll show some of the benefits of having an LLC when we get there. So with a sole proprietor, there's just one owner, and that owner assumes all the liability of the company. So if the company takes on debt, usually the owner will sign on to that debt. The owner will fill out the application for the loan or what have you, and the owner assumes all the liability. And if the business were to be sued for whatever reason, then the owner would assume the liability if there is a judgment and the business owes somebody money in that respect. This is easily mediated with insurance. There's a lot of companies out there that are affordable. I'm not going to advocate for any particular one, but there are a few out there that you can find for less than $100 a month if you have a low amount of revenue or receipts in the beginning. You may find that it's pretty affordable, even if you have, a piece of real estate or a brick and mortar place where slip and falls can happen and stuff. You'll find that regardless, it could be surprisingly affordable. I would recommend that you consider just remaining a sole proprietorship when you're brand new until the business gets off the ground. If you do, then you won't have to worry too much about all the paperwork to dissolve with the state. If you discover the business isn't going to work out and you're going to go out of business or dissolve, then you'll find that being a sole proprietor or a sole proprietorship is the easiest way to back out and not have a lot of administrative responsibilities to wrap it up. And also you can take a break and there won't be continuous taxes and fees like with the other types of limited liability entities like LLCs. Often, even if you don't have any revenue or if you have a loss for any particular year, they want you to pay a minimum tax in more states than not. There's some states out there that don't require the continuous taxes and fees because they want to encourage people to form LLCs whenever possible. But those are in the minority. Most states want you to pay taxes and fees, and that can come as a shock to people that jump headfirst into the LLC route without looking at what their ongoing responsibilities are going to be from the get-go. So the sole proprietorship is not really encouraged by most, but it should be in the very beginning. When it comes to sole proprietorships, all earnings from the business flow onto the sole owner's tax return. So on your individual tax return, you'll pay your own income taxes. It's on a different schedule called the Schedule C. And it's taxed at the same rates as your W-2 wages. So you don't have to worry about paying a additional rate or higher rate on your income taxes. But the biggest responsibility is your contributions to your Social Security and Medicare. In 2020, it was 15.3%. So it can be pretty steep. It's all based on your net profit after your expenses. So you should always try to pad your expenses, business expenses, wherever possible, but you could still wind up with this responsibility. It all goes towards your account for when you retire or if you're ever disabled. So just keep that in mind. It's not a complete loss the way income taxes are. You pay income taxes and you don't really expect to get anything in return. But with Social Security and Medicare taxes, it's like when you are a W-2 employee, you can at least look forward to retirement and those funds contribute towards your account. There are also some local tax obligations in most places, county and city. They're generally referred to as franchise taxes, but they're typically only a very small percentage of your net profit. But just keep in mind that that responsibility is out there, even if you're a sole proprietorship. And of course, that responsibility, city and county responsibility also applies if you have other types of entities But a sole proprietorship is the simplest form, but there is that county and local tax out there, and then the added taxes that are incorporated with your personal or individual tax return. So once you've been in business a while, you can apply for an LLC with your state Secretary of State office. You're going to have a unique name that you're going to apply for. And so that means that you have to do a business search. Usually there's a website with the Secretary of State's office in your state, and you can check to see if there's other businesses out there with the same name that you want. It's like having a personalized license plate. You have to pick a name that no one else is using, no one else is using actively. But usually if you have a creative business name, that's not generally a problem. And you can also apply for something called a doing business as name, where you can pick a name that you're going to be representing yourself as to your customers, and to when you apply for various things like loans and the like. If you want an official name that's followed by the LLC acronym, and then have a doing business as name, you would do that with the two separate processes, the two different forms to apply for the LLC, and then have a doing business as name. That said, the benefits of the LLC is that owners aren't personally liable for the company's debts or liabilities, and that's what people like about LLCs and why they're advocated so much. There are certain characteristics with unincorporated and incorporated businesses. If you are a single member LLC, which means you're a sole proprietor, one owner business that applied for the LLC status, then the income and everything will still flow through, and you'll still pay the Social Security and Medicare taxes and everything. But you would be called an LLC, and you'd also have the flexibility to be taxed differently with the IRS. You can fill out a form with the IRS and be taxed as the other entity types would, but still be called legally an LLC in your state. And like I mentioned, you want to be careful in considering this structure too early. It's hard to back out and dissolve. There's paperwork to fill out. If it doesn't work out, or you decide you want to go back to being a sole proprietor. So I would be wary of this head first if you're not really sure if it's going to work out, or you're just giving a particular business a try. There's fees and taxes, and pretty much in more states than not, they're going to charge you those taxes even if the business isn't doing well. So there are more taxes and fees, but the business can take on debt if the business can build credit. And once again, to get credit to take out a loan or any other kind of debt, you're going to need to remain a going concern, or you have to remain a profitable business for a while for banks or lenders to trust you to even give the LLC a loan in its own name. But if you're able to do that, then the LLC might be a viable option. And if you're able to do that, then the owner would be protected if there is a default on the debt, the LLC doesn't have the money to pay on the debt, or if the business gets sued. In most cases, you can get protection from those obligations with regard to your personal assets. If you do choose a limited liability structure, you want to take it seriously and treat it as completely separate from the individual that owns it. And the owner is not liable as long as you stick to that and obey that separation by keeping your books separate and from treating it separately and not playing games, as in, muddling your personal transactions with your LLC transactions, or having only one bank account for both your personal and business, or dissolving and activating, applying to the Secretary of State, every very frequently to either create an LLC or dissolve an LLC. That kind of stuff kind of makes the courts raise an eyebrow, and they might refuse to recognize your independent status with the LLC if you aren't respecting the fact that it's a separate entity and applying for loans in the LLC's name once the LLC is able to build credit. If you take out a loan in your own name early on because the LLC doesn't have credit to do so, then you can expect to be personally liable on that particular loan. And also, if you act personally and create a lawsuit because you contracted in your own name, or you harmed someone in your personal capacity, then you can also expect to be sued personally. But if you otherwise behave as if the LLC is separate, then everyone will respect that, and you'll only be responsible up to the amount of the assets that are in the LLC or contributed to the LLC. Now, if you have more than one operator of a business, then you can have two or more parties manage and operate that business. There would be a separate tax return, and usually it's a separate tax return that's filed with the federal and the state, but the income would still flow to the individual tax returns. So the tax return that is filed by the partnership, assuming there's two or more parties that are starting a business and creating a partnership, that income would flow through, but you'd still have this obligation called an informational return, which the partnership would have to file. The partners are subject to the same types of taxes as sole proprietors or LLCs. And also keep in mind that partnerships with two or more operators or members, as they call them, can form an LLC, and that would be called a multi-member LLC. So with the sole proprietors, that's called a single member LLC. And with the partnerships with two or more owners, that's called a multi-member LLC. And like the sole proprietors, I always like to mention that you may be subject to local, county, and city franchise taxes, or taxes attributed to the local government. So just make sure you Google those obligations before you start so that you know what you're up against. There's also a separate return that would need to be filed for the city or the county if applicable. So everything's assumed to be unincorporated before filing anything. With a partnership, there has to be some kind of agreement, but usually you can agree on terms orally. If it's a small business that hasn't really got off the ground yet, you can just agree to be a 50-50 partnership, or whatever kind of way that you want to divide the profits and the losses. If there is a loss in a given year, you can agree on that orally. Generally, it's recommended that you have a written agreement, because there can be disagreement down the road when it comes to dividing up the profits and everything. You can imagine how that goes with money. People generally want to disagree about that type of stuff, and you told me this, you told me that. So it's better to just get it in writing so that you can have something to refer to in case there is a disagreement down the road between the partners. And unless there's an agreement otherwise, you're assumed to be general partners. So each would assume the liability of the partnership based on the division of the profits. Personal assets are exposed. So like with a sole proprietorship, if there's no incorporation, then the partners are going to be liable in case there's debt or liability or the business gets sued. The partners could be liable up to the extent of their personal assets in addition to the business assets if you didn't form an LLC. There's typically little chance of being sued, and the business doesn't really have any credit to take on debt in the beginning. So Instead of being too scared of this, too scared of the fact that you are exposed in case there's a problem, I would recommend that you go a couple years and make sure that you have a profit for a couple years before forming an LLC. Because again, it's hard to back out of an LLC. There's generally a lot of paperwork, and you don't want to go through that administrative nightmare until you know that the business is going to be doing well for a while. So this one has a lot more text, and that's because this is probably the most complicated of the entities if I had to pick one that's complicated. They're usually, you have to be profitable for a while before this is a viable option for you. You know, sometimes people will incorporate right away, even if they don't know it's going to work out, because they want to have that INC after their name officially. But that's generally not a good idea, because I'd say if the LLC was hard to dissolve, the corporation is really hard to back out of and wind up everything if you decide it's not going to work out. There's some startups that have a lot of investors, third-party investors that want shares and want a contractual obligation to form a corporation. So those people have to form corporations. Those businesses have to form corporations. But I'd say if you're just starting a small business from your home or otherwise, that you would wait until you have serious profits down the road before you form this corporation entity status. The corporation is given legal personhood at the state level. So that means that the state is going to recognize it as a separate entity, much in the way that the federal government would if you applied with the IRS for the corporate status on your LLC, which you're allowed to do. You're allowed to apply, for example, an LLC, you can apply for the IRS to be considered a corporation for tax purposes and be taxed the way of a corporation if you want to. But here, the state is going to be recognizing it. And that said, you can't take on debt or liabilities on the corporation's behalf. Any new corporation has to build credit and apply for loans separately, much like an LLC. And anytime a shareholder, even a shareholder that formed the corporation, wants to add their own funds, wants to take out a loan in their own name and add it to the corporation, they're entitled to an additional stake in the company. So someone that starts a Inc. or a corporation that wants to add money in the beginning will be diluting the shares of others because they're going to be taking on more shares, which they're legally entitled to if they add to the business. A pro is that they don't assume any personal liability for debts or obligations, much like an LLC. The liability is limited to the assets in the corporation, or that's generally called the retained earnings. Also, the fixed assets and the like that are on the asset side of the balance sheet, which I showed last week, those are also up for grabs if there's debts or liabilities out there that need to be paid. But generally, a big plus is that the shareholders are not responsible personally. They can't take your house, for example, if there's liabilities or debts of the corporation that need to be paid. Another plus is that the shares of a corporation can generally be sold, and they have a market value, even if they're not sold on the stock exchange. They have a value which is determined by the buyer based on the future earnings. And so you can sell your shares not in the open market unless you're on the stock exchange, but if you have anyone, a private buyer that's particularly interested in the business, you're welcome to sell the shares, to have a contract for sale and sell the shares. But typically shareholders will sell their shares, and that's how they make their money on the shares that they have acquired and kept for a certain amount of time. And the only other way to really make money on stock is to wait for the corporation, the powers that be or executives, board of directors to declare a dividend. But then you're beholden to the corporation and waiting for them to actually declare the dividend. And that might be problematic if you want to make money frequently and regularly. The corporation can sometimes take years to declare a dividend, and it's totally up to them when they decide to do so. The dividend is a payout of the retained earnings that the board decides they don't need for future operations. They want to incentivize and raise the stock price by paying a dividend because that makes the stock more valuable. And when the stock's more valuable, then more people want to buy it, and there's generally more accessible funds when people buying shares if people want to buy the shares. So that's the incentive of the board of the corporation to declare and pay dividends. But they have to wait for the dividend. The shareholders have to wait for a dividend, and there's a lot of back and forth, a lot of discussion between the accountants and those that work for the corporation with the board of directors to finally find out if they can afford to declare a dividend and that they don't really need the money for other operational purposes. And that's usually a lot of bureaucracy in the corporation, and it usually results in a long waiting period for them to actually declare and pay a dividend to the shareholders. And it's very organized. You have to have a board of directors, which is appointed by the shareholders, and typically their elections are mandatory in pretty much all states. Periodic board meetings are mandatory, so they have to convene and have a quorum and discuss various matters about the corporation on a frequent basis. Even if there's nothing to really discuss, they still have to convene. The board of directors do. And there have to be written bylaws and articles of incorporation that are up to be amended periodically at those meetings. And they're kept as public records with the Secretary of State. So before you can even form a corporation, you have to have some form of bylaws and articles of incorporation, which are kind of like the rules or laws that the corporation is going to abide by about their purpose, for example, and also the shares authorized, as well as, a litany of other things. There's two levels of taxation in a corporation. So again, the state recognizes the corporation as having its own legal personhood. So it's its own legal entity, and it's going to file its own tax return. And the corporation owes taxes. Ostensibly, some big corporations don't, because they have expensive lawyers that can get them out of obligations, to be quite frank. But the way it's supposed to work is that corporations pay taxes on their retained earnings every year, like a person would pay taxes on their income. So when money comes into a corporation, but it's not paid out in the form of dividends, the corporation will still have to pay income tax on whatever amount the corporation made. But then again, if any dividends are declared and passed to the shareholders, those shareholders have to pay a lower rate for dividends that they received on their personal tax return. They'll have to pay another rate for any dividends that were paid. That's considered personal income to the shareholders that received their dividends. If there's a small corporation that meets various requirements, they can be taxed by a favorable tax system that's in a different part of the Internal Revenue Code, or the statutes that deal with corporate income taxes, federal income taxes. And these requirements are pretty strict to be an S corporation, but if you're smaller and all of your shareholders are US citizens or residents, and you only let out one class of stock to your shareholders, meaning you don't give them a lot of various options about their inherent powers becoming a shareholder, you may be able to apply and become an S corporation with the IRS. And a S corporation is able to flow through their income and they would not have the double taxation. So their income would flow through much like a partnership would. And those shareholders would only pay tax at the personal income tax level. There wouldn't be the corporate level income tax the way other corporations would that are not S corporations. The other type of corporation, if it's not considered an S corporation, is called a C corporation. So the C corporations with the IRS have the double taxation at the corporate level and the individual level. And then the S corporations, if you opt in and apply for that and qualify, the income flows through and the corporate retained earnings or corporate income would not be subject to tax. Only the tax would only apply as the income flows through and hits the personal or individual tax return. And that's a way that the government has incentivized small businesses by letting them avoid that double taxation if they elect to become an S corporation. And you hear this cooperative term thrown around a lot. It's a trendy type of entity where the employees or workers that run the everyday operations also have a right to future profits and benefits. Unlike a corporation, the shareholders and the employee workers are the same people. So with a cooperative, it's formed a lot like a corporation would be formed, but they don't allow third parties that don't work for the organization to have shares and be owners. That's written into the articles of incorporation and bylaws, a restriction of who they can sell shares to. All member votes have to be weighted equally. And so someone that owns more of the corporation has more shares than other people, doesn't have a greater say in how the corporation operates compared to everybody else. So it's one owner, one vote. And that can be either a good thing, it's more democratic, it allows everyone to feel like they're having an equal say, even if they don't own a lot. But then the people that do own a lot say, well, I bought all these shares and I feel like I should have more of a say because more of my money is at risk. Then they should probably just go buy stock in a regular corporation. Because with a cooperative, you're really incentivized to have people working in the business all voting equally on the goings on of the business, and to not have any one person have a much greater stake than everybody else. That's the benefits of the cooperative if you decide to go that route. And they have shareholders and they have a steering committee, much like the board of directors, and they have to have bylaws and articles of incorporation. They usually survive better because the workers or the employees are incentivized to do their job well, because they know if they do turn a profit, then that's going to help them themselves, because as workers, employees, they're also the owners of the cooperative. So typically that's why people say that they survive better in early years compared to a corporation, for example, because they're more incentivized to do well for the business. And often these are charitable in nature. They're not completely charitable, but they're charitable because they put profits back into the community. So an example of cooperatives is usually a lot of small mom and pop type places that are local. They'll be considered cooperatives because they're reinvesting back into the community, and they say so, and they use that as an advertising point. They say we're giving back to various organizations in the community, and that's why you should come and shop with us. All right, and like I said, it didn't really take a lot of time. Explain the implications. Let me get to a question here. Explain the tax implications for sole proprietor making charitable contributions. So in 2017, they changed the law. They doubled the standard deduction on personal tax returns. Typically, you don't get a write-off or what's called a tax expense, a deductible tax expense that reduces your taxable net profit. You don't get that from charitable contributions, or else, there wouldn't be any reason for having the different tiers. Since a sole proprietor is what I mentioned, a flow-through entity, all the net profits are being passed to the personal return, and they don't consider charitable contributions or donations to be business expenses, quote unquote, that reduces that taxable net profit before it flows down to the personal tax return. So that said, you can't avoid the standard deduction. So, and people have had mixed feelings about the doubling of the standard deduction. It's a good thing for people that didn't have a lot of itemized deductions. But if you didn't have a lot of itemized deductions or most of it was charity, you'll come to find that you have to take the standard deduction, even if you have a substantial amount of charity that you give. That's especially true if you don't have things like mortgage interest and the like. So yeah, it will flow through, and if there won't be any tax benefit if the standard deduction, the new standard deduction, which I think for married filing joint filers is $24,400, and it goes up. They've now arranged it so it will go up a little bit every year, but not by much. And so unless you are someone who can give more than that, plus mortgage interest and the other types of itemized personal expenses that are out there, like medical expenses is another example, then you may not be able to take advantage of a tax break from your charitable contributions. Those are considered personal itemized deductions on your personal return, even if they're paid from the business account. I wish I had better news, but
We've got lots of time for questions here today. So if anybody else has questions, feel free to use the Q&A functionality in Zoom or comment on the Facebook group.
We've been ending pretty late, so maybe we can leave on time today.
Yes. Yes, if we don't have any other questions, I'll just wait one more minute. Let me check our Facebook group. I don't think we have any there either. So with that, thank you. Thank you, Jay, so much for going through all of this with us here today, and all the other work and webinars that you've put in over the past month. They've been so informative and so impactful to so many small business owners in our community. So we thank you. And we thank everyone who joined us here today. I will send out a recording of this webinar as well as Jay's previous webinars later today after this call. And we hope that you come back for more. We'll should be in touch with you, Jay, about possible future topics. And like I said at the start, if anyone watching us has an idea or a topic that they'd like us to cover in the future, please do send that along. All right, I don't see any other questions. So like you said, we'll end a little early today. Thank you again. Have a great weekend and a great week ahead.
I hope that was helpful, everyone. You have a good rest of your weekend too.
Absolutely. Thank you.
Bye, Morgan.
Bye.